A very good morning, guys. Last episode, I told you Monday changes the close. Well, here we are. From today, the exchanges settle every futures at a single auction price at the bell. And it is the first session your whole career has tracked under the new rule. But that is not the biggest thing of the weekly calendar because the market walks in on three straight up days, stalled dead under 24,400 with the fear gauge asleep at 3 month low, and in 2 days the central bank decides the rates. Here is the part almost nobody is watching. Under that dead calm tape, the professional desk spent Friday quietly buying insurance on both sides, calls and puts, and played for a big move, while the crowd sold it to them. And this morning, the market is not waiting. It is gapping up straight up into that ceiling. Cheap options, a resistance, gap up, and a governor on the clock. So the real question today is not which way, it is whether the pros know something the calm does not. This is the Tanmayach. You are listening to episode 94. I am Tanmay Kuttagoti. Let's go. So, starting with the board, Friday Nifty closed at 24,383, up 66 points, the third straight day up. And the watch intraday it poked its head up to 24,429, about 24,400, and then got sold straight back to the close underneath it. The 24,400 resistance held on the close again. Sensex closed at 78,094, up 166 points. On the week, Nifty added 2.59%, Sensex added 2.68%, the best weekly recovery of the whole of July, and the fear gauge India VIX fell to 11.76, a 3 month low. Price up, fear died. Hold that pairing because it is the whole plot. But look under the tape because Friday was different from Thursday in one healthy way. Thursday, the rally was narrow, only the heavyweights. Friday, the breadth improved. 28 of the Nifty 50 rose, and the broader market went into green. The mid caps, the small caps, both up. This is a healthier tape. Still, the muscle came from two places: financial services up nearly 3%, and autos nearly up 1.6%, with the Bajaj twins, the stars, Bajaj Finance up 8%, and Bajaj FinServ up 6% on their June quarter results, and M&M up 3.6%. On the other side, the drag was the same two names it had been all the week. IT down 1.5%, TCS and Infosys both down more than 2%, and the FMCG down 1%, with ITC off 1.5% after a soft profit. So the earnings reaction is already in place in the tape, not waiting for Monday. Maruti actually finished green despite a 9% profit dip because the top line was huge. The market picked its winners on Friday. Today it lives with them. Now the positioning, and this is where the calm gets interesting because the desks are not acting calm at all. And this is the official participant data for Friday, starting with proprietary desks. Uh, so they came off their futures long to flat, and they did something you only do when you expect a big move. They bought both sides. They added long calls, 1,55,000 of them, and they flipped their puts from short to long, adding more than 2 lakhs on the long puts in the single section. A long calls plus long puts to bet on a big move either way, and they put it on while the volatility was dirt cheap. The foreign funds told the same story from a different seat. They covered 13,500 of their index future shorts, so they are net short about 1,73,000, but the covering continues. They added to a huge long book in a single stocks, and against it they stayed short calls and long puts. Translate the whole FII position, a protected long, buying stocks, capping the upside, paying for downside insurance. And the retail crowd, they sold puts, another 2 lakh 17,000 of them, and now nearly short 7 lakh puts. So here's the picture. The smart money pros and FIS spent Friday buying protection on both sides and at a 3 month low volatility. The crowd spent Friday selling it to them. When the pros are paying up for a move and the crowd is underwriting the calm, you know who tends to be right. And the cash market backs the constructive side. On Friday, both institutions bought. The FIs a small 277 crore and the DIs institutions a bigger bid at 2260 crore. That is a reversal from Thursday when the domestic sold into strength. Zoom out for the year and the rules are clear. The FIs are still net sellers of about 5,700 crore. The domestic net buyers of over 32,000 crore. The home bid is the floor under the market. On Friday, it showed up in size. Now, overnight, and it is set up to be a gap up. Wall Street closed Friday at record and the S&P at 7489. The Nasdaq at 25,000, almost 400. Amazon jumping over 15%, and this morning Dow futures are adding another half percent to it. Yep, but Gift Nifty is the headline. It is trading about 180 points up, 3/4%, and it is pointing to us a gap open near 25,560 straight into that 25,500 to 600 resistance. And here is the twist. The rest of the Asia is soft this morning. Japan down over 1%, Korea down more than 3%, giving back Friday's surge. So India is gapping up against a heavy Asia on its own steam, straight at one level that has been capped every push this cycle. One caution, I'll keep the read. Wall Street strength is coming up, rising long-term rates, and the America 30-year near its highest since 2007. So this is a risk on with a rates undertone, not a clean all clear. And on commodities, uh, picture just turned friendly again, which helps us. Crude, which had bounced to 90 on Friday, reversed hard overnight. Brent is back down near 84, almost 5% off. And for an economy that imports most of its oil, that is a real tailwind, not a tax. Gold is firm near 4060, the rupee steady near 95.40, and the dollar easing. So the macro backdrop is actually supportive into this gap. Cheaper oil, a firm rupee, US futures green, nothing here is fighting in the open. The open event big enough to move this market is the one that options are still refusing to pay. So, uh, from an education point, let's talk about that because it is the lesson of the week. Everyone knows that RBI meets this week and decides on Wednesday. So, why is the fear gauge at a 3 month low and a weekly options volatility crushed almost to 9%? So, 2 days before the rate decision, here is the rule worth keeping. The market does not pay for events, it pays for uncertainty. A rate decision where 68 of the 72 economists agree on a hold is not uncertain, it is a formality. So it earns almost no premium. Contrast that with a job number, a genuine two-way shock, where insurance stays expensive right to the print. Same size event, opposite pricing, and the only difference is how unsure the market is. The only thing that can hurt them is the outcome nobody hedged. This week, that tail is hawkish hold, a RBI that keeps the rate but sounds worried, and it is to live because the June inflation ran to almost 4.38%, guys, the hottest since the December 2024 uh, highs. And look who is already positioned for exactly that. Pros buying puts and calls on both ends. They are not predicting a hike, they are buying a lottery ticket because it is on sale. So the plan is simple and it runs on Tuesday's weekly chain. Recomputed of the Friday's official settlement, the put writers built the support. The biggest put resistance support sits at 24,000. Another big shelf at 24,200. That is your support. The call writers own the ceiling. And here is the mechanic. They rolled the resistance up on Friday, covering calls at 24,200, 300, and stacking fresh ones at 24,400, 500, and 600. So now 24,600 is the heaviest resistance of the week. Max pain sits at 24,400. PCR is firm at 1.49, and weekly is pricing a move of about 240 points, a one standard deviation band of 24,168 to 24,600. So here is the gap changes. We do not open at 24,400 asking to reclaim it. We open near 560 to 600 at the doorstep of 24,500 and 600 resistance itself. So today's clean binary test. If the buyers hold this open and push through 24,600 on rising open interest, The heaviest resistance of the week breaks, and the next stop is almost 24,800 to 25,000, and you are going to ride it. If the call writers defend and the gap gets sold back under 24,500, then 24,500 the pin reasserts. The fade confirms. So watch closely on 24,500 strike being held or not, and for a breakout 24,600. Given low and falling volatility and a consensus hold coming, my lean is the writers will defend and this spins. But this is the whole point of today. The pros just told you the override. A gap straight into the wall is exactly where a move ignites. And if volatility pops, there both sides bet pays. So own a little cheap volatility so you can do option buying today for tomorrow and day after. Do not sell naked at premium. That is one thing. Two bookends. First, the mechanics. Today is day one of the single auction closing, so the last half an hour will behave differently than it did on Friday, and the first few sessions under any rule are the noisiest. Do not read a strange close as a signal. Second, our rupee case all cap book rebalanced says today on a 2 week clock into a fresh basket. Next rotation is fortnightly, and on Friday it did its job, up 0.88% against Nifty's 0.27. The small and mid caps carrying it. A systematic book rotates on the calendar, not a feeling. So scorecard is available on rupeecase.com, and Friday I am going to give myself roughly a 4.5 out of 5. That's the edge for today, guys. 3 up days settled under a wall, the fear gauge asleep, and a center bank 2 days out that almost nobody expects to blink, which is exactly why the only real risk this week is surprise nobody paid to hedge, and the pros spend Friday quietly buying the ticket. So sell the calm if you must, but keep a little of what they are buying, because cheap volatility is gift right up until the warning. So buy the dip. uh, Check for the resistance. If it breaks, go long. This was the Tanmay. If you found value in this, guys, please share it with one trader friend who needs it right now. Subscribe on Apple Podcast, Spotify, and listen it live and first on rupeecase.com. And give it a rating, guys, and a review if you want to add something to the podcast.